Welcome to my end of year property market report for the upper quartile market. After the events of recent years, it is perhaps no surprise that the concept of a normal property market in 2022 proved somewhat wide of the mark. For much of the year, property prices continued on an upward trajectory and competition for available properties was still high. The market defining the wider economic rhetoric that was hitting the headlines. The unintended consequences of the ill thought through growth plan have, however, forced a brake to be applied to the market, as the implications of higher mortgage borrowing for both current and prospective home purchasers, alongside the rising costs of living, hit home. The government's autumn statement has to a large extent calmed the waters, but with economic uncertainty, both here and abroad, 2023 will undoubtedly see some readjustment of property market metrics. The balance in the property market is shifting back from sellers to buyers. Demand from prospective home owners and movers is returning to pre-pandemic levels, and the market is becoming much more price sensitive. Rightmove report asking prices of newly marketed properties fell by 1.1% in November, in line with the long-term average. Meanwhile, Zoopla report 1 in 4 properties sold since September have experienced a price reduction, 11% selling with a reduction of 5% or more. In the southeast, properties are currently selling in 41 days. This is only 4 days slower than a year ago, but far quicker than 69 days reported by Rightmove 3 years ago. Property pricing and annual growth remains in positive territory, but both the Nationwide and Halifax reported month-on-month price falls in November. The Office of Budget Responsibility predicts property prices will fall by 9% over the course of 2023-24, before growth returns to the market in 2025. This represents a less severe market downturn than either during the global financial crisis or the recession of the early 1990s. It should also be considered in the context of the significant price rises since the market reopened in June of 2020. The average price of a property has increased by over 20% in that time. Unlike in previous downturns, it is highly unlikely that the market will be flooded with sellers needing to sell. The tightening of the mortgage lending regulations ensures that far fewer households hold less than 10% of equity within their property. Home movers and prospective purchasers will no doubt be more discerning in their choices, with factors such as energy efficiency and running costs rising up the priority list. The majority of purchasers will benefit from the nil rate stamp duty taxation up to $250,000. For first-time buyers, this has gone up to $425,000, which the Prime Minister has confirmed will remain in place until the 31st of March 2025. Within the prime market across the southeast, annual price growth in this market is currently running at 9.8%, and the average price of a prime market property is over £1 million. The prime markets in Chichester and Brighton are currently seeing the strongest price growth. Prime market buyers often have much more equity and are less reliant on mortgage finance than the wider market. The value of sterling against the other global currencies continues to offer savings to those purchasing from overseas. Despite the turmoil created by the mini budget, thanks to its culture, educational provision and breadth of offer from country homes to city centre penthouses, the UK still has a lot to offer prime property purchasers. So with this in mind, I wish you a happy Christmas and a prosperous 2023 and look forward to helping you with your property needs in the new year.